If you've ever stared at an options chain and felt completely overwhelmed by all those numbers, you're definitely not alone. Choosing the right strike prices for a credit spread is one of the most common stumbling blocks for beginners. And honestly, it's the kind of decision that can make or break your trade before it even gets started. So in this video, we're going to break everything down in plain English. No confusing jargon, no unnecessary complexity. Just a clear and practical way to understand what you're actually doing when you set up a credit spread. Let's start with the basics, so we're all on the same page. A credit spread is an option strategy where you sell one option and buy another option on the same stock, with the same expiration date, but at different strike prices. It's called a credit spread because you receive money up front. You collect a premium when you enter the trade. And your goal is to keep as much of that premium as possible by the time the trade expires. There are two main types of credit spreads. A bull put spread, which you use when you think the stock will stay flat or move higher, and a bear call spread, which you use when you think the stock will stay flat or move lower. Both follow the same principle, just from opposite directions. Now, here's where most beginners get stuck. When you place a credit spread, you're not just picking one strike price, you're picking two. And those two strikes together determine everything about the trade. How much money you can make, how much you can lose, and how likely the trade is to actually work in your favor. Let's start with the most common approach. Selling an out-of-the-money spread. This is where both of your strike prices are beyond the current stock price. And there's a good reason why this approach is so popular. The stock doesn't actually have to move in your favor for you to make money. It just needs to not move too far against you. Think about it like this. Let's say a stock is trading at $100. You sell a bull put spread with strikes at 90 and 85. Both of those strikes are below the current stock price. So as long as the stock stays above 90 by expiration, both options expire worthless, and you keep the full premium. The stock can even dip a little, maybe to 92 or 93, and you still walk away with maximum profit. That's the advantage of out-of-the-money spreads. Time is working for you. But there's always a trade-off. When you sell spreads that are far out of the money, your probability of success is higher, but the premium you collect is smaller relative to what you could potentially lose. You might collect $80 or $90, but have several $100s at risk. That can feel uncomfortable at first. But it makes sense when you consider how often these trades actually win. Now compare that to selling an at-the-money spread. This is a more aggressive approach. Instead of placing your strike comfortably away from the current price, you place it right near where the stock is trading. The benefit is immediately clear. You collect more premium because the option you're selling has more value. And because you collected more upfront, your maximum loss is smaller for the same spread width. So on paper, the risk to reward looks better. But here's the trade-off. You have very little room for error. The stock doesn't need to move much against you before the trade starts going wrong. So while the reward looks better, the probability of success drops. And this leads to one of the most important ideas in options trading. You cannot have both high probability and high reward at the same time. When one goes up, the other goes down. That's simply how options are priced. So how do you actually choose your strike prices? There are two main ways to approach it. The first is using the chart. Look for areas where the stock has struggled to move beyond support and resistance levels. Recent highs and lows. If you're selling a call spread, you place your short strike above resistance. If you're selling a put spread, you place it below support. But here's the key. Don't place your strike exactly at that level. Give yourself a buffer. Move your short strike slightly beyond that area. Because markets are not precise. Price often tests levels, breaks them briefly, and then reverses. That buffer is what protects your trade from normal market movement. The second method is using probability. This is where delta comes in. Delta gives you a rough estimate of how likely an option is to expire in the money. Many traders choose short strikes in the 16 to 30 delta range. That typically means a higher probability that the option expires worthless. But here's the part that matters most. There is no single perfect strike price. There is no exact level that guarantees success. What matters is consistency. If you consistently choose strikes within a similar probability range and manage your risk the same way every time, that's where your edge comes from. Because this is a probability-based approach, and probabilities don't play out over one trade. They play out over many trades. One trade by itself doesn't mean much. What matters is how you execute over time. Once you've chosen your short strike, the long strike becomes much simpler. Its job is not to generate profit. Its job is to limit your risk. The distance between your short and long strike defines your maximum loss. That's your spread width. Wider spreads bring in more premium, but they also increase your potential loss. Narrower spreads reduce your risk, but also reduce your reward. So again, it comes down to balance. Let's walk through a simple example. A stock is trading at $100. You identify resistance around 110. Instead of selling the 110 call, you might choose 112 or 115. That gives you a buffer. Then you buy a higher strike, like 120, to complete the spread. Now let's look at the put side. If the same stock has support around 90, you might sell the 88 or 85 put, then buy a lower strike like 80. Now, as long as the stock stays above your level, you're still in control of the trade. This is where most beginners make mistakes. The first mistake is choosing strikes too close to the current price. It's tempting because the premium is higher, but your probability drops significantly, and the trade becomes much harder to manage. The second mistake is going too far out just to feel safe. Yes, your probability increases, but the premium becomes so small that the trade is no longer worth the risk. The goal is not to be aggressive, and it's not to be overly conservative. The goal is to be consistent. Think of it this way. You're not trying to predict exactly where the stock will go. You're creating a range, and as long as the stock stays outside that danger zone, you win. You don't need a big move. You don't need perfect timing. You just need the market to behave reasonably. Quick recap. Choosing strike prices comes down to three things: where you draw your line, how much buffer you give yourself, and how consistent you are with your approach. You're not trying to be perfect on one trade. You're building a process that works over many trades. Now, once you understand how to choose strike prices, the next step is just as important. How long should you stay in the trade? That comes down to expiration dates, and that's what we'll cover next. If this helped you understand strike selection in a way that actually makes sense, hit the like button. Drop your questions in the comments. I read every single one. And subscribe to Option Framework so you don't miss the next video. See you in the next one.